Hey, it's Matty Loans, your mortgage expert. I'm back in the lab here to remind you that trees don't grow to the sky, but conforming loan amounts may have buyers reaching for it very soon. Another year is almost over, and the latest buzz in the mortgage business is that the conforming loan max will increase for the ninth year in a row. Every year, new loan limits are announced for mortgage loans, which may be purchased by Fannie Mae and Freddie Mac. These GSEs represent the two largest agencies in the secondary market that purchase book loans from lenders. So, what does this say about the state of real estate and how will this shape next year? Today, we discuss that and four other reasons why I think real estate continues to go up, up, and away. First, none of the data I'm going to reference today is by any means a leading indicator. This is more relevant events and how it may impact mortgage and real estate in the short term. In summary of 2024, it was another strong year of appreciation for residential real estate. Interest rates have improved just enough, and real estate practices have changed. We also have a new administration taking the wheel of the economy next month. There's a lot of debate regarding the health of the real estate market. Listings are up 15% this year, while the volume of home sales remain in the gutter. Everyone agrees that home prices have gone up too high, too fast, but it's really anyone's guess when and if they're going to start to level off. Now, on average, national home prices are up about 5% this year, and we've been told for the last 2 years now that things should level off. The new conforming loan limit is now $806,500, which is more than a 5% increase from last year's figure of $766,500. That's nearly a whopping $40,000 year-over-year increase. Now, the increase is superficial. Looking at the history of the loan max, you can see that it usually increases every year, with the exception from 2006 through 2016, when the loan limit rested at $417,000. We all know what happened then, and real estate was in a bear market, taking about 5 years for prices to bottom out. Now, since 2016, the real median home price has provided healthy annual appreciation, but it's important to note that this is a strong increase in an already overwhelmingly unaffordable market. The loan increase means a few things for those looking to buy a home in the short term. First, greater leverage. The increase allows prospective borrowers to finance a larger purchase price with a minimum down payment. Some programs allow as little as 3% down, so in theory, you could buy a home for $831,500 and only have to put down the minimum. Now that sounds crazy, given that it would take $25,000 in just down payment, but understand the principal and interest payment on that loan amount by today's interest rates would be well over $5,000 a month, and that doesn't include mortgage insurance, property taxes, and homeowners insurance. You're going to need at least 2.2x of your monthly debt in loan qualifying income. Two, in an interest rate declining market like this, it may help banks offload some of their portfolio loans to the GSEs. This should help banks reallocate their capital, taking loans off their books so they can help the next portfolio customer. It's only $40,000 of an increase, but with home appreciation and in that combination, with the expectation that rates come down in 2025, this should add lubrication to the tight credit market and make it a little bit easier to find options. Bigger picture, no matter what we hear from the Fed this month or next, the idea that Fannie and Freddie are eligible to purchase loans of higher amounts doesn't appear to ease housing inflationary pressures. Think about it. For those making 20% down payment, you can now buy a home for $1 million and get a conforming loan. This means that there's more competition for the same loan because now you don't have to work with a big box bank. You can get your loan just about anywhere. Banks, mortgage brokers, credit unions, and I think this is going to make the mortgage market even more competitive next year. Because let's face it, you can get a conforming loan amount just about anywhere. This creates more options for consumers but also more competition within the business. Now, if you've been waiting for a crash, you just may need to wait longer. I know it feels like home prices are in another stratosphere, but the reality is that home prices are always out of reach. If you tune into the Fed, you'll hear Jay Powell himself say that housing is a long term problem and we're underbuilt homes, with some sources say it's only 1.5 million units on the low end, but on the high end, it could be as high as 4.5 million units. The loan amount increase of the last 9 years in a row, and the last time there wasn't an increase was in 2016. If real estate values were poised to go down or struggling to stabilize, I don't think it makes sense for an increase or an increase as large as 5%. Very soon, 806,500 will be the baseline loan max for a one unit property in any town USA. There are going to be higher market classes in areas where the super conforming loan will be in excess of 1.2 million. I don't think a move like this indicates home prices are losing steam. More than likely, they're going to continue to appreciate. One of the more significant events of 2024 was the National Association of Realtors settlement surrounding real estate commissions. From a banker's perspective, I don't think materially this changes the game. Commissions are and always will be negotiable, and the settlement doesn't limit commission specifically. It does limit what agents can and disclose on a listing, but in terms of the offer and the structure of commission, it's not going to be any different than it is today. Now, if you're a seller in this market, especially if your profile buyer is a first time home buyer, do you think it benefits you to not pay a commission? A lot of firsties only have so much to spend on a home. And why would anyone want to limit potential offers because you want the buyer to add the commission to the acquisition price of the home? I don't see how this would help. Now, we're only months into this practice, but it's been business as usual thus far. Further, I think this catches the market by surprise and actually improves the business. Mortgage originators went through somewhat of the same thing 10 years ago with TRID. It did change the disclosure process start to end, and the changes were tough at first, but everyone develops a system and after a while, a workaround. It's going to take some time to get used to, but I think this educates the consumer and ironically brings in more interest into real estate. Anytime you're educating a consumer on the description of service or services and the ways they can leverage it, I think this only encourages home ownership and home sales. A more educated consumer is a more powerful consumer and should translate into higher frequency of real estate activity. Some folks think realtors are overpaid, but the truth is they're very hardworking people. They have to study the market, build relationships, manage the process, and homes, especially in this market, do not always sell themselves. The 2024 market and the 2022 market are very different. Should values continue to increase, I think this only brings in more potential earnings for realtors, and in turn, they're going to make more. The next metric promoting increased values is the labor market. Last week, we got a surprisingly good read on job growth after the previous month flatline. Now, unemployment also ticked up just a bit, and I understand these figures are constantly revised, but many think the September rate cut of 50 basis points was in reaction to a lackluster job figure and the increasing unemployment rate. Powell stated for the last two meetings, the balance of risks is more in focus, moderating inflation with a labor market that's no longer overheated. It's a good combination for real estate when quits are way down, openings are above the levels we saw before the pandemic, and it appears that many workers are testing out the market for higher pay. This does not compare to the 22 job market, but the labor market is as good as it's going to get. Think about it. We're at 4.2% unemployment. With the exception of the pandemic, the last time unemployment was at this level or higher was February of 2018. Until this changes significantly, meaning higher unemployment, employed people will have money to spend and will look to buy homes. Anything less than 5% unemployment should be considered max employment. And if there are more job openings than there are unemployed people, this is going to support the real estate market further. Then there's the Donald factor. In January, 45 becomes 47 with promises to smash inflation, clean up waste and abuse. Already, we have a soap opera brewing between Chair Powell and President Trump. We all know Trump wants lower rates and lower energy costs, and we'll have to see what exactly plays out on tariffs. But people have high expectations for Trump in this economy. The US doesn't make a whole lot of anything anymore, and perhaps the only thing we do produce are our own homes. Perhaps when President Trump refers to removing regulation, this will impact the availability of land to build and help break up that not my backyard crowd and get perhaps builders some stimulus to build more homes. Now, more homes will increase supply. We already spoke about the increase in listings, but I still think there's a challenge on the production cost of single family homes. It may increase the availability of homes, but I don't think the price. It still takes time to build homes, and I wouldn't expect any real change to take place earlier than year two. If the US has a more efficient and productive economy, more people will hold the goal of home ownership as a priority. And I believe we're witnessing a big change in the sentiment already. And while home prices remain out of reach, the prospect of lower interest rates should provide enough impetus for people to get back in the game. Actually, the showdown between Trump and Powell, I think, is overblown. I think they're both really after the same thing, a period of normalcy. Powell stated that interest rates should normalize as the current monetary policy is still restrictive. Ultimately, I see them working together and creating a more optimistic future about the economy, the labor market, and home ownership rates in America. Now, that's my story, and I'm sticking to it. We'll see what ages better, my predictions or my lip hair. See you soon.